Welcome once again. This is very timely information about the housing market and everything relates to it. This is Siwei Yi, and my special guest is Richard Advani from Guarantee Rate Mortgage. Richard is a investment loan agent who does investment loans and every other loans in all the 50 states, have done it for more than 10 years and are one of the top investment loan agents in the country. Without further ado, we got very valuable information to share. Let me share my screen and go over this article. This article comes from housingwire.com. The headline is Mortgage Rates Decline Amid Banks Failure. What's next? I highlighted a few things. Let's go over one paragraph at a time. 30-year fixed rate mortgage has decreased. Today is March the 17th, Friday. And let's talk about Silicon Valley Bank and Central Bank and the banking financial crisis and how is it affecting the housing market, because a lot of negative headlines out there, a lot of doom and gloom scenarios. The world's coming to an end. Everything's crashing. Let's be real. Let's go over the realities of it. Richard, without further ado, what are your take on this banking crisis?
In terms of what this means for the market and for stocks and everything else, who knows? I would like to say unprecedented. A little shocking that here we are 15 years after the financial crisis and there's been a bank failure. Now, is this going to be isolated to one or two banks? When it first happened on Friday, the general consensus was yes, but then we hear about Credit Suisse needing to tap into $50 billion and a bunch of other local and regional banks. And then, of course, signature banks. It is definitely unprecedented times, and we'll kind of see what ripple effect this has everywhere else. It's tough to tell. What I can tell you, though, is out of everything that happens that's bad for a lot of people, there's definitely some big opportunity in what's happened with interest rates because of these bank failures. To elaborate on that a little, mortgage interest rates, as we all know, pretty much tripled last year. They peaked out about the third quarter of last year with the 10-year Treasury bond reaching the mid-4s, 4.5 or 4.6. And if you're not aware, mortgage rates are pretty much tied to that 10-year Treasury bond. When the Treasury bond goes up, fixed mortgage rates go up, and when it goes down, vice versa. We peaked out third quarter of last year in the mid-4s, and investor rates were low to mid-7s, if you guys remember. And that's when a lot of people were really on the fence at that point. Since third quarter of last year up until about a month and a half ago, that 10-year Treasury dropped closer to the mid-3s. Investor rates moved down as low as the high 5s to low 6s with points, of course. And, of course, there was this influx of people wanting to buy real estate because the difference in cash flow between 7.5 and 6.25 is huge. And what kind of happened after that is the Treasury bonds are definitely tied to inflation overall. They move with inflation data. And if you guys didn't pay attention to the market, as of about a month to month and a half ago, the general consensus was that the Fed's moves were doing a good in terms of reducing inflation. But then we had some CPI numbers come out that showed that inflation is still running rampant. And what happened? The Fed's increasing the rates. And along with that CPI data, the 10-year Treasury bond started rallying upwards. And as of Thursday of last week, the 10-year Treasury bond crested over 4.0 for the first time in 3 months. Mortgage rates moved up about 0.5% from the lows we experienced earlier a month ago. But more importantly, the conversations I was having with clients too, as of last Thursday, was 5 days ago or 7 days ago, was that with inflation data not being as good as expected, and with it in all reality going to continually not be as low as the Fed's targeting, that my projection was that interest rates were going to continue creeping up to the highs we experienced at the third quarter of last year, which meant rates going up another 0.5% or so. Now, of course, what happened was a completely unforeseen. The next day, that conversation changed sharply because I'm sure you guys are aware, Silicon Valley Bank, I had never heard of it first. I don't live in the Bay Area, but massive bank essentially went belly up and the Feds had to overtake it. Now, what happens when a bank goes belly up or there's turmoil in the banking industry? People look for security and safety for their money. And even though the yields aren't extremely high, there's no more safer to put your money generally with these US government bonds. So there's a huge influx of money into the bond markets. And what happened, in turn, was that 10-year treasury bond dropped sharply on Friday. And once again, if you remember, that's what mortgage rates were based off of, or are based off of. And so the question on Friday was, hey, is this temporary? Is this a reaction to the market? Or are they going to continue to drop? Are they even going to flatline here, which would be great because that's a big drop in a day. Monday came around, dropped another 6%, right? So by that point, between last Thursday and Monday, rates were down north of 0.5% with those reductions. Now, what we saw on Tuesday was the Treasury bond went back up like 5 or 6%, right? Once again, we were trying to determine, is this temporary? Is this permanent? Is this rush into Treasury bonds going to be prolonged? And more importantly, are these lower rates here to stay, right? And also, even lower, are they going to drop further? Now, Wednesday, Treasury bond went up. Thursday came down. Yesterday was Thursday. Today, the 17th, Friday, they're down again very sharply, right? So rates have dropped even more. We're down almost 5% on that Treasury bond to 3.4. Now, what that means is essentially, as I said, in a week, rates have dropped very sharply. And it still begs the question is the current 3.4 we are seeing now going to be sustained for a while? Are rates going to be sustained for a while? Is it going to move lower? Or is this turmoil going to be isolated to a couple banks? Is everyone going to calm down over the next couple days, couple weeks? And is that Treasury bond going to move back upwards? So that's the big question mark. It's tough to say what my opinion is just because things have been so volatile and we're dealing with something, I don't want to say unprecedented because it happened 15 years ago, but unprecedented at least in the last decade, right? We don't know what tomorrow is going to bring in terms of news. If the bank debacle is actually more systemic and spreading to other banks and affecting the financial system, then I think we definitely will see that Treasury bond maybe even drop more and also be prolonged, which means these lower rates will be here to stay and potentially move lower. However, if once again news simmers, that Treasury bond could move back up with rates. Now, what does this all mean for you at home? Firstly, this is a Hail Mary. I was so nervous on Thursday of last week, a little over a week ago, about the rest of the year because rates were already moving up and were projected to move up more. Now we're here where they're much lower. So if you've been waiting to refi, do it now. Whether it's with me, whether it's someone else, whether it's your brother-in-law, whatever, get off the fence, go do it now. If you've been waiting to buy investment property or rental home, also go do it now. The difference between 5.875, 5.99, which we can probably get today on an investment deal, and 6.99, or almost they were a week ago, is a huge amount of cash flow. That's the difference between a deal potentially penciling out or not penciling out. Try to go find something ASAP, find something that's ready to get under contracts because you can only lock your rate once you have a specific deal picked out. Take action ASAP. We don't know how long these are going to last. It could be merely a couple days and the Treasury bond rallies upwards next week just as quick as it came down. So as we always say, get off the fence. This is a glitch in the matrix and this is a huge opportunity. Actually, I'm excited. I'm excited to, as soon as I finish this, I'm going to be reaching out to all that may not be aware of what's going on right now. But good times for investors right now. Let's take advantage of this.
Absolutely agree. Yeah, that's my take as well. The big picture is right now is a great opportunity to take action, whether you are a real estate investor or a primary home buyer, especially for primary home buyers, if they can afford to buy a house that they want. Right now is a great time because the competition is still very low. So let me segue, look at great information, Richard. When we get back to the article, Let's see what they're saying to support what you just validated. Right now, the mortgage rate is around 6.7. What I've found is that the treasury rate or whatever the treasury rates are, the spread between the treasury rates and the mortgage rate is around 3 percentage points. So if the treasury rates are 4%, that means the mortgage rate could be around 7%, give or take. Let's monitor this, the spread as we move forward. And this article going to say that turbulence in a financial markets is putting significant downward pressure on rates, which should benefit borrowers in the short term. Exactly what you just said. Lock in the rate and take action for everybody out there. And let me see, the Mortgage Bankers Association, they have seen the increased volumes of loan applications have increased 6.5% for the week ending March 10th. Yeah, things are happening. Activities picking up, especially during the strong spring housing market season. Let's look at what this individual, the weeks ahead, Nick Shah, which is the CEO at home.LLC, he said, explained that the mortgage rates are tailing the treasury yields in the short term. Investors flock to safer assets and fears brought by the bank collapses, and the 10-year treasury note fell from nearly 4% at the start of last week to 3.4% by midweek. And with mortgage rates dropping, quote, housing affordability is improving and supporting home prices, Shah said. Exactly what you just went over a moment ago. And let me go down here. Realtor.com says Hannah Jones, the economic research analyst, said, however, in light of last week's bank failures, the committee may choose to remain conservative to ensure stability in the economy. This next paragraph, I want to highlight Goldman Sachs estimate that the stress on the smaller banks could result in tightening lending standards. Now, you being a lender yourself, have you seen current tightening of lending standards, or do you anticipate any significant tightening of the lending standards, or which just no big deal?
We've not seen any real changes or tightening yet. We have in more of the non-traditional product, the DSCR loans, but keep in mind all the loans that typically we get as investors are conventional loans, Fannie Mae, Freddie Mac, government-sponsored loans. We haven't seen, I don't anticipate any really either. There's not this huge turmoil right now that's affecting anything. I anticipate guidelines will stay the same. There should be no change to limits on finance properties or down payments or anything of that nature.
Here, next two paragraphs, which I highlighted, is very intriguing. You and I need to do an additional deep dive on, especially this last paragraph. Before I get to the last sentence, let's go over what Mr. Shah has said. In long run, whatever that means, long run, he said Shah expects the Federal Reserve to increase rates slowly in the medium term because the job market remains strong. Consequently, home prices will keep declining further, albeit slightly. Now, it's not crashing, nothing like that. And then this sentence is very intriguing. Again, there's only opinion by one individual, Mr. Shah from home.LLC. Let's see what he has to say. Maybe he's being misquoted. I'm not sure. Here's what he said as he concluded his comments, opinions. Mr. Shah said, meanwhile, when rates hike ceases in the long term, demand will rapidly increase, but the housing supply is still near an all-time low. Then, he said, home prices will skyrocket. Okay, now let's read into what he just said. You and I, let's give it a shot. What he meant, what do you think he meant by that? Any kind of underlying deep dive we can interpret what he just said?
That's what we said, right? The housing market's super strong and robust, and the external factor that is slowing things down is the Fed increasing rates, right? So once that external factor is gone, the fundamentals, as we've always discussed, supply and demand still is a major issue. What happens when rates move back down and inflation is under wraps? Boom, right? We're going to be in a even bigger of a housing rally than we were in before. There's lots of people out there screaming doom and gloom, and I say everyone hold on to your seats because I see quite the opposite happening. Now, look, if as a country we enter a recession that affects everything, sure, housing is going to be affected like everything else, like we as well, right? Everything around us is going to be affected. But that doesn't change the fact even coming out of that, we still have major supply and demand issues. People are still locked into their homes at super low rates, right? So affordability is ridiculously bad for new buyers, but everyone who's already owns a home compared to where inflation is now, all you owning a home out there can testify, right? Bread has gone up 50%, eggs, triple, like everything has gone nuts the last 2 years. What hasn't changed? Your mortgage payment. There's so many people locked into low housing numbers because they have those low rates that they're not going to let go of their house. They're not going to sell their house. People are locked into more equity or have more equity in their homes than they've ever had historically in this country. Untapped equity. So all you doom and gloomers out there, like housing's going to crash and all this. If you have $300,000 on your $600,000 house, you're going to sell it. You're not going to get foreclosed on. Just you got $300,000 equity in there. And also, if you can't afford your payment, you're at a 3.5% 30-year fix. You could probably run it out for at least what your payment is. I don't see this a major contraction or crash happening as you got pulled up there. It's all about supply and demand. Get away from all the other stuff you hear. Get away from all the noise, all the statistics, all the data, right? Everyone can understand supply and demand, right? If you're selling 6 lollipops and you got 10 people in line, you know what? It's going to be easy to sell those lollipops. Those lollipops are going to sell for a lot of money because you have those 10 people in line. And that's the basis for any investment. Supply and demand is not going to change. We're majorly short nationally. I think once you understand that, then it's logic and common sense at this point in terms of whether you should or should not invest in real estate for the long term.
Yep. Here's my take, Richard. I can see that slideshow right here. You're absolutely right. The homeowners right now, they dictate the market. They are in control of everything. There's no stress out there because the supply inventory is so low. No homeowner right now to have a 3% 30-year fixed rate mortgage going to move up to a 6.5 to 7% mortgage and double or triple their mortgage payment with a higher price point. The move up buyers is not happening right now. And the only way you can move any of these current homeowners that own this low rate, let's say the only way, if the mortgage rate comes down to maybe 5.5%, then you may have a small portion of the homeowners that have a 4% rate. They might want to move up. They may. For people that have 3.5% locked in rate or 3% or 2.5%, there's no way in hell they're going to give up that historical low rate unless the mortgage rate falls down to 4%, which is not going to happen. We're going to have a massive shortage of homes, not this year, not next year. I believe for the next decade, there'll be continual massive shortage of inventory. And so it bodes well for people that can afford to buy right now and beyond, to have good financials, risk investors with prime time to pull the trigger because so many people cannot afford to buy homes anymore. The rental market will be the strongest renters nation in the history of America. I'm seeing bidding wars in our local markets in Florida and Texas by renters. In fact, I used one of my videos that I've done last week, one of my house in Hawaii. In between tenants, I received 100 rental inquiries for my rental in Hawaii, and they are bidding against each other. My listed rent was too low. They asked for a higher rent to bid out another renter. And instead of doing 12 months rent, my property in Hawaii, this one renter, he wanted to rent for 18 months at a 15% higher rent. That scenario I'm experiencing is happening on all the real estate investors, on your properties, also on your 20 properties. And many of our real estate investors, their rents are going up like mad because of all this situation. So great time to be a real estate investor, even with a higher rate, as you and I discussed. You take the interest rate, you marry the investment property. So anyway, Here's my takeaway. And one more thing in terms of banking crisis, again, the YouTube videos, all those crash videos out there in YouTube, they are getting a lot of clicks, but they're reporting on this doom and gloom. Fine. That's how they do things. Unethically, immoral. But isolated event of a banking crisis, or the government is protecting the banking system. They are coming to the rescue. To me, this is temporary, hopefully. No one knows for sure. But you're right. And when there's a crisis, there's an opportunities. And for real estate investors that you and myself, we're helping right now is an opportunity amid in all these crises. That's my recap. That's my takeaway. So what is your final level recap?
As I said earlier, there's a very unique opportunity with where interest rates are right now. A week ago, they were dramatically higher. If you're waiting for that magic moment of something to kick you in the butt and make you take action, it's here. And we don't know how long these rates are going to last. Definitely get off the sidelines, reach out to me. I'm going to be slammed, as you can imagine, with this drop in rates. Drop me an email. We'll schedule a time to chat and look forward to working with you guys.
Sounds good. Thank you so much. Bishop Avani from Guaranteed Rate Mortgage. Great, insightful, value add presentation as always. This is Siwing Yi. Have a nice day. Bye-bye.